Good afternoon, everyone. My name is Kamal Manocha. I represent PMS AIF World. For last 3 years, we have been religiously doing, webinars to educate ourselves, our clients, our partners, and the rhythm goes on every Friday evening. Today, we have another, very interesting and young fund manager, and we are wanting to actually particularly focus on understanding what are the top three sectors that kind of look interesting in terms of valuations and possibilities of massive growth over next, say, 3 to 5 years. That is the, I would say, specific topic that we have for today. And the context of this topic is that we know that over last, 5 years, many sectors have become favorable and they made a lot of wealth. And then obviously, because valuations went up, they went out of favor. But what happens when investors kind of remain hooked to certain businesses and do not see what factors drive sectors? They kind of tend to continue to hold on to such businesses. Today, we know, for example, for that matter, many investors might be hooked to many pharma stocks, many IT stocks, many financial services stocks, many auto stocks. But it's not that every stock, every business continues to remain favorable forever. So it is definitely important to understand what are the various drivers which are running and which are kind of posing challenges as well as, I would say, opportunities in the economy in terms of driving those sectors. And it is important to understand the top down view as well, though obviously most fund managers and most of us are always wanting to focus on the bottoms up approach. But today's webinar is going to more talk about the top down approach, because given the volatile asset class, and given the state of economy as India, which is growing, but the world, which is a western part, is not growing and is maybe under a threat of recession as well as high inflation, and interest rates are also kind of rising. So given these macro driven risks, it is important not to ignore the top down view, and that is the broader reason why we are doing today's webinar. So we have amongst us Mr. Aniruddha Sarkar, who is the CIO with Quest Investment Advisors. And why particularly we selected Aniruddha Sarkar to do this webinar? One, obviously the topic is very important, and second, Aniruddha can do justice to this topic because he brings with him exactly same top down oriented experience, and he's currently applying that experience in terms of trying to manage a fund which Quest had launched 6 months ago, and they've already raised around 400 crores, and that fund is Quest Smart Alpha Sector Rotation Fund. The fund which is actually very very interesting in the context of trying to generate alpha by trying not to stick to particular sectors but trying to rotate between sectors. We will discuss about that fund also maybe as part of Q&A. But before that, let us understand from Aniruddha what is his perspective on top three sectors that look ahead in terms of possibilities of massive wealth creation. Over to you, Aniruddha. So to begin with, we would want to understand from you, what are your broader views on the macro opportunities, challenges, and then we can narrow down further.
Sure, Kamal. So thanks for having me here, and a warm welcome to all the audience who's attending it at this point of time, and also who will be kind of watching it subsequently on the YouTubes. I would say, one thing which you mentioned very aptly is that most of us are always, in fact, most of us have been always the bottom-up investors. But I think the last 4 or 5 years, the way the world has been kind of evolving, I think it has become very, very imperative that we definitely keep one eye on what is happening in a broader macro picture. And that is where we decide which sectors you want to be in and which sectors you have to avoid. Because I think, a company bottoms up might look excellent, but if that whole sector is going through a bad patch, even a good company will continue to underperform for a decent amount of time. And as investors, you tend to lose patience and then exit out of it. So before we come down to the sectors and the what we like and why we like, I will try to give my view on the broader macro picture and where kind of I would say where India lies. One thing has become very clear, I think, in the last 18 months, that the way India is positioning itself in the world picture is very different compared to what it was in the past. And I think in the last 15 to 18 months, the most of the concerns which we used to see around whether it's the US Fed hikes happening, the RBI hikes happening, or inflation, or the Russian war, or the pandemic which impacted economic activity everywhere, it never occurred prior to those things happening that India will emerge as a very, very bright spot. And earlier we used to talk about India being a bright spot among the emerging markets, but now it seems it's the brightest spot, not just among emerging markets, but also when I compare it to the other evolved economies. The interesting part is that all those concerns which were there, whether we talk about the US Fed hikes, RBI hikes, inflation, the Russian war, all those are already factored in. And in fact, if you look where the Indian markets are, corporate earnings, valuations, I think it's all factored in there. But if you look at these events, how these events have impacted India and how these events have impacted the rest of the world, they are two different poles apart completely. And I think in our lifetime, we have not seen a country like India, emerging out of all these uncertainties as a very, very strong economy, and not just economy on itself. It's emerging as an economy wherein other parts of the world are looking towards India to kind of, help them out in this environment. Now, that is where I would say, that old saying that, India's time has come. I would say, in fact, India's time has come now. And that is where, if you see all the sectors which we are focusing on, the sectors which I'll talk about subsequently, also the sectors which we are overweight in our portfolios, it all evolves around this basic thing that from being just the IT services back office of the world, India is gradually evolving to becoming the manufacturing center of the world also. All this while, I would say China had this particular, I would say, the label wherein that, you are China was the manufacturing center of the world. India was the IT services back office of the world. I think India is now gradually trying to take that particular title away from China. Obviously, we don't need to replace China completely. All we need to do is take around 10 to 15% of their market share. And that's kind of going to be a very, very massive jump for us. So I would say that the other part which has become very evident in the last 18 months, and that is more from a market perspective, is the fact that unlike the past, India or Indian markets rather are not so much dependent on the FI flows. And I used to be always of the view that, FI flows are more of the hot money. Now, now the reason for calling it hot money is that, they come fast and they exit equally fast. And that leads to decent amount of the gyrations in the market, not just about the prices, but also the valuations. Now, what has changed in the last 24 to 36 months is that the domestic participation in the equity market has gone up a lot. And that is one big trend, which I would say is going to transform the Indian equity markets, wherein more and more domestic money, domestic savings is going to come into the market. And that is something which will make us much more, I would say, resilient to the shocks which keep happening outside India. Because typically, if you see any negative event happening anywhere in the world, FIs don't take time to press the button. And they will kind of, exit in a panic. And we saw what happened in the last 6 to 8 months. And that leads to massive, massive disruptions in prices and the valuations. And that is something which I would say we are getting into that shape wherein we are in a very comfortable zone where more and more domestic money is participating. And this is something, if you would see, has happened wherein in spite of, I would say, the record amount of FI outflows from India, Indian markets did not fall as much as what many other markets fell over this period. And now with only a fraction of that money coming back from the FIs, we are practically back at the same level where we were, say, 4-5 months back. So that shows the resilience of our market. And to be honest, it has taken most people by surprise, not just in outside India, but also inside India. There were many investors who were kind of, obviously it's very natural. It's not that unnatural. It's very natural when, you have so many negative news around you. It's very natural that, you will want to wait for a better level to enter. But having said that, I would say that this entire sharp up move, which we saw from, say, 15,100 to 17,600 levels, it has taken everyone by surprise. But I would say this bounce is not on the false footing. This entire bounce which has happened, you have the strong rationals for it. And the rationals being what I mentioned is that the core macro picture which is emerging out of this entire, the dust storm which is there, is that India's core manufacturing services, IT services is getting stronger and stronger. One interesting thing which is there about Indian economy is that India is not India is one of, I would say, a unique case in itself, because it is both a service provider and a manufacturer and a consumer. The large consumer base which is there in India, that gives it a lot of support that we don't need to depend on exports as much as what many other countries are dependent on. And that is where I would say the resilience of our economic strength, our growth, comes into picture. In spite of the world growing at, say, 1 to 2%, IMF, World Bank, and all large agencies have projected India will grow at 6 to 7% even in this year. So this shows, the resilience of our domestic consumption, which is supporting the domestic output, and that is something which I would say more and more FIs have become acquainted to. One more point which I would like to mention is that many investors used to ask me over the last couple of months that when will FIs come back and why did they exit? The reason for their exit was that India was getting sold as a part of the emerging market ETF outflow which was happening. The first leg of selling was because of that. The next leg of selling which we saw post October of last year was the whole balance of weightage was getting adjusted. India had outperformed most other emerging markets, and because of that, it had its weightage into the emerging market allocation within the portfolios of those foreign investors had gone up a lot. Now, because of that, the weightage adjustment was happening, and what we saw is that outflow of money from India. But our view has been that, and continues to be, that over the next 12 months, 24 months, 36 months, you will find a large amount of money coming back to India, not just in FI form, but also in the form of FDI, which is much more important. So both FDI and FI money is going to come back to India. And this will come back more from a focused India fund. And that is where it lies the confidence that along with the domestic investors' participation going on, FI money coming back into India will definitely keep our markets outperforming in the medium to long run. Valuations can be concerned on and off, and that is something which we need to keep an eye on. It's not that you get all buoyant in the market and you jump in the market. You need to keep an eye on the valuations from time to time. But that is where I would say active management comes into play, wherein you keep an eye on the valuations. You move out of sectors and companies which are overvalued, and you get into sectors and companies which look attractive at that point of time. So my view from here on is that India is the place to be. From an investment perspective, I would say valuation wise, right now we might be quoting at around 18.5 to 19.5 price to earning based on the 1 year forward multiple, which I would say is slightly higher than the long-term average. But it is not a place wherein it's very expensive. We can do some time correction wherein we continue to spend a decent amount of time at the current levels. But I would say these are time frames, and I've been highlighting on this point again and again for the last 4 to 6 months, that use this correction in the market, both price correction and time correction, to increase your allocation towards good quality companies across market caps in specific sectors which one needs to identify. And that is where I would say there's a huge scope of opportunity to make money in the market. So that's my broad view on the market.
Right, Aniruddha. Thank you so much for your views. So particularly, we have always been recently talking about manufacturing sector as, one of the next big sectors. Many mutual funds have launched manufacturing focused funds. Many, I have seen portfolio management services have allocated money to, manufacturing sector. And obviously manufacturing is a industry, it's not a sector. Maybe it covers many subsectors. So I want you to first of all explain, what is going behind the scene. Why is manufacturing as a industry or a sector looking attractive, and what are the, I would say mini sectors within that or business models within that, which you are particularly bullish upon, and again, reason that with certain data for us to kind of, get complete understanding.
See, the main reason why everyone is now gradually looking towards manufacturing is that if you look at the last 5, 6, 7 years, a manufacturing industry, as you rightly mentioned, has not been doing very well. You had your economic activity which was below your 6%, and at the same time, the past capex which was done, the capacity, the utilizations were kind of, below 75%. Typically, you find the new capex happening when the capacity utilization goes above 70-75%. Now, it was all underutilized, and at the same time, the economic activity was extremely weak. But if you look at the manufacturing sector's share in the Indian economy, at this point of time, we have actually reached back to the pre-COVID the numbers. And the last 2 years was an aberration wherein, I would say manufacturing activity came to a halt altogether. But now, as we speak, I think, we have come back to the pre-COVID levels when it comes to the, the manufacturing, the share of the GDP. I would say that, the various enablers for, the higher growth in the manufacturing activity, which are there, I would say is the major part of that is the Capex cycle, which is picking up. And this Capex cycle is something which I would say is unlike in the past, wherein it was focused on only one or two sectors. This time around, the Capex cycle in the economy is across multiple sectors. And the biggest enabler of that, I would say, is the government push towards domestic manufacturing. Now, because of this government push towards domestic manufacturing, small, mid-sized, large companies across sectors are seeing the opportunity and they are going for capacity expansion. Now, this is something which is leading to a massive Capex cycle opportunity across the economy. This time around, I won't be surprised if you find that, companies which are enabling these Capex to happen, reporting numbers which are going to be all-time highs in the next 4 to 6 quarters. Now, I'm talking about companies which enable the Capex to happen. And this time around, I would say when we interact with all these companies, interesting part is that what they say that earlier the Capex which they used to execute used to be for the public sector companies, and they used to be the large 1,000 crore, 5,000 crore, the huge projects, which used to take 36 months, 48 months to execute. Now what they are seeing is that they are seeing a huge basket of small Capex happening. 50 crore, 100 crore, 150 crore, 200 crore, the small Capex happening. And these are happening from the private companies. And that is something which is giving me confidence that we are in the early stage of a massive Capex upcycle. And that is the reason I'm bullish on manufacturing and industrials. In fact, out of the 3 sectors which, I'm bullish on and which we have large allocation in our portfolio, first one is your manufacturing and industrial. When you talk about the subsectors under that, I would say one of the biggest allocation which we have in our portfolio and where we are one of the most bullish is defense. For the very reason that what has changed post the Russian war is that more and more it has become, I would say, aware for everyone that for your defense, you can't depend on anyone else. And that is where it has come to hit hard, even I would say not just the government, but even I would say very excellent private companies, that why can't we make the top-notch defense equipments if we are making the same parts for other countries? And that is where I would say that defense is a very large scope of opportunity within the domestic manufacturing. Also for the very reason that if you look at the defense budget, it is one of the biggest budget which we have every year. And within that, there are 2 parts of the defense. One is the units. Second is the maintenance. Earlier, we used to do only the maintenance work. And for the new units, we used to acquire from outside. Ironically, the maintenance is a small part of the entire budget. The new acquisition is the bigger part. We used to always do the maintenance job. Now we are getting into the manufacturing part of it. And that is where I would say is the biggest opportunity. And you will have big companies which are there in the public sector, which are executing these projects. Whether it is your aircraft or electric equipments, or you're talking about the warships or the ammunitions, etc. I would say there's a huge scope of opportunity over there. So defense happens to be the first big space within the India manufacturing, which is something I would say investors should have in their basket of allocation. And this is not something which has played out. Like, when I talk about defense, many investors tell me that, hasn't it already played out? I say that, what has played out, we are just in the initial phase of it. And if we want to replace the big boys of the US defense economies, I would say you have to play the defense for the next 4 to 5 years. And that is where India, not just from making for itself, will also start exporting to other countries who want to buy from India. And in fact, if that happens, I won't be surprised if the same equipment we sell to other countries at a fraction of the price. And this is something which will attract more and more international customers to moving towards buying defense equipments from India. The second big, I would say, subsector which we like is auto and auto ancillary, because for the very fact that last couple of years, auto as a sector has definitely gone through the bad patch. Earlier, you had the COVID lockdowns, because of which, your transport and everything was shut. Post that, you had the big shortage of the semiconductor chips, because of which there has been a huge backlog of the auto being supplied to the consumers. And that's the reason when you look at any company, whether it's M&M, Maruti, Tata Motors, everything, you find there's a huge backlog of orders which is there. Now, the other factor is that we believe that this sector has a huge scope for growth, partly because of the huge demand which is still unmet. Secondly, because of the whole migration from the internal combustion to the EV. Now, these are the two things which will continue to drive the auto sector, not just from a domestic consumption point of view, but also from, I would say, an international export objective. Now, within the auto, if I talk about that, why auto? As I mentioned, it's not just the auto OEMs, but I would also say that investors need to bet on the auto ancillaries. And when you're looking at the ancillaries, it should be engine agnostic. It should not be too much dependent on whether it's an IC engine dependent or EV engine. In fact, many investors ask me that, are you betting on EV in your portfolio? I would say that there are not too many options as of now in the listed space if you have to bet on EV. But yes, there are some options wherein they would be having some exposure to the electric vehicles, either on the four-wheeler or the two-wheeler. And that is where one can look at allocation. But still, I would say you can bet on many engine agnostic companies, both on the OEMs as well as the ancillaries. One is the domestic demand, which I'm seeing is huge, continues to be very, very firm. Second is the replacement opportunity from IC engine to the electric engine. And the third opportunity is from an export opportunity. Now, the reason for betting on the export is that international OEMs used to historically have good, I would say, the relations with Indian auto ancillaries. In fact, Indian auto ancillary ecosystem is among the top 3 in the world when it comes to the technology. Now, post-pandemic, more and more international OEMs want to increase their sourcing of components from India. The other part is that Europe is going through a massive, massive energy issue. And that is the reason you'll find the cost of production of these ancillaries in Europe is gone over the roof. That is where India has a very, very big scope to jump in and take advantage of that price and the cost differential over there. Earlier, China used to get the big share of such an opportunity, but definitely post-pandemic, this has shifted to a large extent towards India. The other important part is that in India's ecosystem of auto ancillaries, you will find the number of companies which are there across the length and breadth of different components of the entire auto is huge. For the same component, you will find 4 or 5 players who are there. That gives a lot of scope for evaluation for the international OEMs. When they come into India and they want to evaluate the partner, this gives them a lot of, I would say, diversity to pick up the right players over there. So auto ancillary is the second big sector within the domestic manufacturing, which we are betting on. The third would be, I would say, the white good manufacturers and also the small industrial goods. Now, these are because historically, we used to find that bulk of the components used to be imported from Southeast Asia. Now you're seeing most of these components doing backward integration and manufacturing those components within the country. There are plants being put up for doing the backward integration and manufacturing those components within the country. And that is where I would say there's a huge scope of opportunity in the next couple of years to unfold. Overall, between all of these, I would say defense, auto ancillary, white goods, small industrial goods, I would say there are also opportunities which are enablers of these domestic manufacturing, which means, which I mentioned earlier, those are the industrial companies who are enabling the capex or the capacity enhancement of these different sectors which are happening. So that is again a large opportunity which I will say investors should keep an eye on. So this is the broad theme around the domestic manufacturing, which I would say, as you rightly mentioned, is that more and more people are getting aware. One common question which I again get, as I mentioned, that is all this already priced in the prices of many of the industrial companies? I would say if you have a horizon of 6 months, then yes, they are priced in. If you have a horizon of 36 months, I would say we are in an early stage of the big run. So depends on your time horizon. If you're looking from a 6-month perspective, you might say that the next 1 year earnings are already priced in. But if you're looking for the long run from a 36-month horizon or a 48-month horizon, I would say we are still at an early stage of the big industrial growth which is going to happen.
Right, Aniruddha. I think the subsectors that we have covered in manufacturing, were very interesting. Most of us understand manufacturing broadly as a theme, but subsectors, particularly that you talk about, we cannot talk about stocks, because we do not want to kind of sound like stock advisors, which we are not. So the themes that you have discussed are quite interesting and intuitive. One particular question, which I would want to ask you, which somebody has asked over chat also, would you define pharma as subset of manufacturing?
See, yes, I will say pharma, chemicals, textiles, these are all the subsets of the manufacturing. But then what we have to see is, again, what I mentioned in my initial discussion, that one needs to keep an eye on the valuations and what earnings growth you are seeing over there. Now, pharma historically has done very well, and I don't see that growth picking up from where we have been doing in the past. Whereas all these other sectors which I mentioned, whether it's defense, auto anks, or the white goods, etc., those did not see the growth in the past. So that base effect is there. But pharma has been doing well since 2011. Since 2011, pharma had seen a good run with regard to exports to all the countries in the world. So I don't see pharma growth being there at this point of time, which can justify the high multiples. And that's the reason you'll find in the last 6 to 12 months, pharma has underperformed big time because of a valuation mismatch with regard to the earnings growth.
Other, has subsectors like generic drugs, APIs, companies like Syngene Industries, which are like research-based companies. So, would you want to avoid all of these types of pharma businesses?
See, I will say that since my approach has been always to be very very focused in the few sectors where you see the biggest opportunity, I would typically avoid the entire pharma. So if you look at my this particular AIF which you mentioned, in that I don't have any pharma, I don't have any IT. The reason being that I'm not negative on the Indian IT industry, but I'm concerned about the mismatch being there between the valuations and the earnings growth possibility. So that is where I would say that both pharma and IT for me would be an avoid at this point of time. And I have had that view for the last 8 months. It's not that now they are down, so I'm having that view. For the last 8 months, we have been underweight on pharma and IT. And I would say it's because of the valuation mismatch with regard to the earnings growth possibility and the valuations at which they are quoting at this point of time.
Sure. So this becomes all the more, I become all the more curious to now know what are the other two sectors, because if there is no pharma, if there is no IT, and we have covered manufacturing, I'm sure the next sector, the second sector that you're going to talk about is going to be financials. I don't know if I'm right or wrong, but
No,
can
you're
you
bang on. I would say you're bang on that, because if you don't have pharma, IT, and financials, then definitely you don't have 50% of the index. But yes, I would say the second sector which I'm very bullish on is financials. And when I say financials, I would like to make it clear that it is not just the banks, but across the spectrum of the financials. And that is where I would say investors need to focus on, wherein it has to be banks, NBFCs, insurance, asset management companies, a basket of them. And that is where I see the bulk of opportunity. Now, the reason for being bullish on that is that what has happened in the last 6 years, obviously, there have been many hiccups along the way. It has not been a very, very smooth run for the last 6, 7 years for the government. They have implemented very, very harsh measures like the DMON, GST, everything. But some went down well with the public and some did not go down well with the public. But I would say some of the biggest transformation which has happened is, one is the UPI transaction, and second is the implementation of the GST. Now, these two things have definitely had a very, very important impact. Now, because of UPI, what has happened is the formalization of the economy has happened to a massive scale, which was unheard of in any part of the world, wherein even a guy selling, the fruit seller on the street, even he has a Paytm or the Google Pay image posted next to his kind of the fruit stall wherein you can make a payment online to him. Now, this is something which is unheard of anywhere else in the world. And this, I would say, has definitely led to a lot of formalization of the economy. Earlier, the same transactions used to happen on cash. Now they are happening online. Second was the GST implementation, which has led to, I would say, the whole tax evasion structure going out of the window. More and more businesses and I would say corporates, small, mid-sized, have come under the tax ambit. And that is where I would say that compliance part has also increased. Now, what is happening is that formalization of economy is basically resulting in increasing the aspirational values for the consumer as a result of basically higher income, as well as better availability of the loan and the financial savings. Now, when I talk about savings, one interesting part is that in India, which is, if I assume, which I say, like, suppose it's a 3.2 trillion economy, and it is one of the fastest growing economy in the world. Assuming the household savings is somewhere around 20%, that works out to around $600 billion of savings. But if you look at the part of that $600 billion, which is there in the mutual funds, it is a small fraction of it. Now, unlike the West or maybe some other developed economies, like if you look at the mutual fund industry in the last 5 years, they have witnessed a massive growth in the AUM. And the industry AUM, I would say, in the last 5 years has doubled from what it was prior to that. But if I look at the percentage where it is as of today, it is a small fraction compared to where it is in the developed economies. Even the developing economies, not just comparing to the developed, but even to the developing economies. Another important stat, why I believe that this whole formalization of the economy, savings moving from the fixed deposits, gold, cash towards mutual funds, equities, is going to be a massive transformation, is another important fact. If you see in India, the number of PAN card holders, there are 50 crore PAN card holders in the country. And the number of Demat account holders are around 8.5 to 9 crore. The number of unique investors the mutual fund industry has is roughly around 4 odd crore. Now, if you have 9 crore Demat account holders, 50 crore PAN card account holders, and only 4 crore unique mutual fund investors, that shows the scope of opportunity even within the people who are already paying taxes. So that shows that, there's a huge number of scope of enhancing the savings, money coming in from the fixed deposits, the cash, gold towards the, I would say, the equity investments. So that's the reason I would say that when I'm talking about financials, I'm not just talking about banks, I'm talking about companies in the asset management industry. I'm talking about companies in the insurance. Now, the reason for being bullish on insurance is that we all know a fact that India is one of the most underinsured country when it comes to the number of the percentage of the population which is insured. And that is where I would say there's a huge scope of kind of, increasing the insurance penetration. And we are seeing those numbers. Post-pandemic, definitely people have become more and more aware about the need for insurance. And that is where I would say companies are definitely seeing one of the highest growth rates they have ever seen. The other part is the core banking. If I talk about the banking sector itself, after a long time, we are seeing the banking, seeing the lending growth happening. And that is where I would say a lot of confidence is coming that the lending growth, the corporate growth, corporate lending growth, the retail lending growth is picking up. And if I look at the growth which is happening, it is happening across sectors. In fact, the retail part is growing faster than the corporate. And if I look at the lending growth, it's increasing across the key segments like the retail, services, agriculture, and industrials. So that is where I would say that it's a very broad-based kind of the lending growth which is happening. And this gives me comfort that this time around the lending growth which is happening in the economy, in the banking system, is not just focused on what just used to happen earlier, which is just the corporates. So I would bet on financials across banks, NBFCs, to bet on the corporate and the retail, the lending growth. Insurance companies, because of under-penetration of insurance in the country, and also the valuations being very attractive now. And the third would be asset management companies to bet on the whole concept of savings moving from physical to the equity savings, which is happening either in the form of mutual funds, the direct equity, etc., etc. So these would be my second bet on the financials.
Sure, Aniruddha. Within financials, what is your conviction or maybe inclination or allocation of your portfolio to businesses like insurance, asset management, pure banking, NBFCs?
See, I would say within financials, if I account, that if I'm putting in 100 rupees in the financials, I would say roughly 15% would be into insurance, around 15% would be into asset management company, around 30% would be into NBFC, and the rest 40% would be into the banks.
And within banks, what allocation towards private banks and public sector banks?
It's a mix. So I'm one of the few ones which I've been betting on the public banks also, and I continue to be very bullish on the public sector banks. I think there's a decent value and growth opportunity over there. So I would say that you should have a blend of both public sector and the private sector banks. In fact, some of the private sector banks which we had sold earlier, they have become very, very attractive. And I would say it's a good time to start looking at many of the private banks which have massively underperformed in the last 18 months.
Right. So now, moving on to the third sector, the curiosity and maybe, the choice is all the more limited, curiosity is high. I had just, designed a poll mentioning that if manufacturing and financials are the two sectors that are seen as, the possible wealth creators over next 3 years, which should be the third one, and I gave four options: energy, real estate, infrastructure, and metals. 45% of audience has voted for infrastructure, and 33% has voted for 35% has voted for energy, 11% for real estate, 8% for metals. So you can understand, the audience is quite informed, and I think is quite wanting to understand which is the third sector and why.
It reminds me of that the old times, when we used to watch Mr. Amitabh Bachchan, that audience poll. And I would say I would go with the audience poll. And as I'm seeing on the screen, 39% has gone in favor of energy and infrastructure. Now I see infrastructure going up. But yes, my third sector is energy. And that has been a key focus area for me. And I would say the very fact that why energy is because that earlier, what we were seeing before the COVID is that the world was moving towards decreasing its dependence on the fossil fuels and moving more towards, the sustainable energy, the renewable energy and the sustainable energy. Now, that whole concept has taken a big, big beating post the Russian invasion, and we have seen that happening. Now, what is being evident is that all over the world, over time, the world they are understanding that we are trying to push the sustainable energy a bit too hard, and we don't have the right capacities at this point of time to replace the fossil fuels. That's the reason you'll find in developed markets now you're seeing many countries going back to the fossil fuels which they had abandoned. Say 1 year, 2 year back, they had abandoned those fossil fuels. They had a timeline in place that we'll not get into the thermal power, etc. But now they are being forced to go back over there, and that is where I would say that we believe that thermal power is here to stay for now. We will definitely, in the long run, say after 10 years, 15 years, 20 years, we'll eventually have more and more of sustainable, the renewable solar energy coming into place. But at this point of time, our view is that solar energy is still not something which can replace the thermal power when it comes to the capabilities to address the entire population of the world. Now, because of that, we are betting on, I would say, companies which are into power production, companies which are into power distribution, companies supplying the raw materials for power production. And that is something which I would say investors should definitely keep an eye on. And the view remains that energy prices internationally will remain elevated over the next 6 to 12 to 18 months. Also, along with that, the prices of the coal is very, very high compared to what it was, say, 8 months back. In fact, historically, imported coal used to be much more attractive compared to the domestic coal. And that's the reason many of the domestic coal mines were economically unviable to do any kind of the mining. Now that thing has turned completely. The domestic coal has become more attractive compared to the international coal. And that's the reason you're finding that government is pushing Coal India to open up many of the mines which were earlier shut because of the supply chain issues or the unviability of the production. And that is where I would say that investors should bet on companies in the PSUs which are into power production, distribution, supplying raw materials for power production. I can understand that these are all companies which are the hated companies. In fact, when I was buying some of the companies in my portfolio, the typical investor reaction was that these companies, they hardly make money for investors. They're only good for the dividend deals. But we have done a decent job in seeing both the dividend yield and the capital appreciation in those companies. So I would say energy is here to stay. Energy as a sector. Along with that, we are also looking at companies which are investing the current cash flows into the future sources of energy, which means companies which are using the current huge cash flows to invest into solar and hydrogen energy. Now, that is again something wherein you are taking advantage of the current elevated cash flows. Either you could be making very high margins or very high cash flows you're making into your current energy capabilities, and you're investing that into the future source of energy. So I would say these are the subsectors within energy which investors should bet on, which is, to summarize, companies into power production and distribution, companies supplying raw materials for power production, and companies which are investing into solar and hydrogen. So these, I would say, are the broad three sectors, if I have to say, wherein I believe the biggest scope of opportunity is there, both from a valuation perspective and an earnings upside. To summarize, industrial and manufacturing, second was financials, and third is energy.
So let us, take few questions from the chat box. One of the questions which I think, should be taken. So though we have discussed about these three sectors, which is manufacturing, for financials and energy, but there are other sectors which are considered to be relatively, attractive maybe at all points of time, which is like FMCG. Now, when we are saying that we are concerned about valuations, wouldn't FMCG be a sector to be considered? Why would you avoid that?
See, FMCG, I would say that definitely it's an outcome. So typically, if you look at consumer discretionary, so I'll put FMCG into that basket of consumer discretionary. Consumer discretionary will be a beneficiary of this entire thing which I mentioned doing well, which means that if your manufacturing does well, more jobs are created, income level starts going up. Similarly, you have more of the retail borrowing happening, your consumption going up. So all this, it leads to, I would say, more and more consumer discretionary spends, which I would say will benefit FMCG companies also. In fact, one small theme which we are also quite bullish on, and we have allocation in our portfolio, is the whole agri-economy recovery. And that is where I would say FMCG plays a big part, because historically, if you see, whenever the agricultural side of the economy starts doing well, you'll find the domestic consumption goes up, and that's a large population belt. Almost like 60% of your population is in that part of the country. So I would say that FMCG benefits a lot when this agri-economy recovery starts happening, and that is where I would say is kind of another important sector where we are betting on. So I would put that as a part of the whole India kind of India manufacturing / the industrial part. In fact, what is very interesting to note is also the fact that we were the IT services back office of the world. We are becoming the manufacturing warehouse of the world, and we are also the supplier of the rice and the wheat to the world. So this is something again which is very, very interesting, that we are actually self-sufficient in all these components.
Right, Aniruddha. So you actually, have discovered and highlighted three sectors, I think, more based on your comfort with valuations. When you kind of avoid sectors like pharma, sectors like IT, your comfort is not there in terms of valuations. And if recently one tries and understands the valuation premium of Indian equities over emerging as well as developed markets seem to have hit all-time high. There was a data by Bloomberg, and I was reading an article I think yesterday. The MSCI India Index benchmark for global fund managers to assess countries' investment performance now has a valuation premium for Indian market over the emerging markets by 96%, which on an average trades at around 45%. So Indian equities trade at 96% premium to emerging markets versus it used to be 45% as an average. And similarly, at 39% premium to developed markets versus maybe 8% on an average. So can you please explain, how big is this risk? Because you have constantly kind of, talked about valuations risk and trying to kind of, avoid valuations risk. And that is where maybe your choice of sectors look to be less interesting, but maybe they are conceptually and theoretically correct, which only future will, tell us. So it is important to understand hence from that perspective.
Sure. See, I would say that from 15,100 moving to 17,700 in a very, very short span of time, definitely the valuation premium will happen, because, wherein the rest of the world has not moved and we have moved up almost like 11-12% in a matter of a couple of weeks. And that's the reason, India has become all the more expensive compared to the rest of the world, because everyone else has not moved and we have moved up almost within 30 days. Now, that is where, again, it highlights the fact that people are getting aware that India is a very, very strong economy. Now, do I see the massive correction from here? Answer is no. You can see some time correction. Now, what could happen is that we might see some pause of the FI money coming to India, wherein money starts going to the other markets. When the other markets start seeing the money flow, you will see those markets also going up. And then this whole valuation premium, which India is quoting at, will decline. So for us to become attractive, we don't need to fall. We just need to wait for others to come up. And that automatically makes us more attractive compared to the rest. So that's the reason, I've been always saying that if the valuations become expensive, you move from one sector to the other where the valuation comfort is there, but don't exit the market, because markets are definitely on an uptrend. If you're there in the market for the next 5 years, 6 years, 8 years, definitely market trend is upwards. But keep moving between sectors and companies, seeing the valuation comfort. You remember, if you remember, just around 11 months back, I was heavily underweight on the banks and financials. And the reason for being heavily underweight on the banks and financials was that valuations were not justifying the earnings. I was extremely overweight on IT for the reason that earnings was growing faster than what the valuations were justifying. Now, if you see my allocation, it's the reverse. I'm more overweight on financials and heavily underweight on the IT. But what has happened is I've just moved from one part of the market to the other part of the market. But it's not that, you sell and you sit at, 40-50% cash. Idea is to be there in the market, but yes, you move between sectors. Even at 17,700 valuations being rich compared to the developed markets or other emerging MSCI index, I would say time correction is very much possible, because if you're moved up so fast, definitely there will be a pause. You can see 500, 600, 1,000 point decline also on the Nifty. It's a matter of a couple of days and weeks these days. But I would say that this is a time wherein I would say these are the halts, rather, or the halts and the pauses towards the big run which is unfolding.
Within financials, gold lending businesses have been kind of, I would say darlings of equity markets over the last decade. Now, given the rise in competition, because banks are also doing gold lending, what is your view? Are you holding any such company in your portfolio?
No, we don't have any the gold lending company in our portfolio.
Sure. Any other, I would say business which is related to financials and has not been discussed? Maybe is a, tech-led, lending business in NBFC as a business model which comes to your mind, because financials is the larger sector in overall context and there are many opportunities. Would you
See,
want to
within the fintech, I would say, there is no opportunity as such to bet on fintech in India at this point of time. If you're talking about the listed market, you have a couple of names which are listed, but yes, I would say that those are not the best of the places to bet on. But more and more banks are associating with various fintech companies to kind of, expand their offerings over there. And that is where I would say it is better to be with the banks if you're betting on the growth and the increased the market reach. Another sector, if you ask me, that which looks, I would say, as a part of your this whole domestic manufacturing, domestic growth side, is the real estate space. So one can definitely look at that part also, which is the real estate part, because we have been bullish on the real estate for the last 18 to 24 months. We continue to be bullish on it even now, because I think the real estate cycle is continuing. And this is again a part of, I would say, the whole domestic focus which is there. Now, if you would have understood from my entire, the sectors which I spoke about, I'm looking at more of India side and less of export side. What we can produce and consume within the country, that is where we are betting on, because I don't want my portfolio or my investors to have that risk that what if this happens in China, what if that happens in Europe, and what if that happens in America. So I would say investors should make their portfolio right now, which is more of within the boundaries of the country. You manufacture here, you consume here. Energy, for example, electricity, it can't be transferred. You can't export electricity. You have to produce in the country and you have to consume it within the country. All these defense, which I spoke about, it's all making and consuming within the country. The real estate is again an outcome of increased household incomes. Financials, when I spoke about investments, asset management companies, insurance companies, banks and NBFCs, which are doing the corporate lending, it is all inward. So nothing is linked in the portfolio, which is dependent on what happens in the world. Yes, they will get impacted to some extent. If the world goes through a bad patch, everybody gets impacted. But one thing is very, very clear. Unlike the past, when you saw a big recession in the West, a big recession in America and Europe, we had a similar kind of a slowdown in India. This time around, it's not happening. To some extent, you can say that we have actually insulated ourselves from the world. But I would say this time around, we will fall for some extent, definitely. It's not that we'll be completely insulated, but the extent of impact to our economy will be not as much as what we have seen in the past. And that's extremely clear, considering the way the domestic manufacturing is picking up.
So some of the sectors that you are not bullish upon, maybe you are less convinced about. Let us maybe for next 1 minute each talk about your view on those sectors. To begin with, infrastructure.
See, infrastructure, I would say that definitely it's something which is in line with India manufacturing and all, but I would not bet on the infrastructure companies. Rather, as I mentioned, I would bet on the industrial companies which are executing those Capex cycle. But yes, I would not bet on the road project companies or the pure infra companies which are there, because I would say that piece is something where I would say I need the visibility that the infra projects are actually picking up to the extent they should justify being a part of the portfolio. And see, at the end of the day, we have a limitation with what you can buy in the portfolio. I cannot end up buying everything under the sun. So within that pecking order, definitely infra is something which is not there in the top 5.
Why you have not talked about with high conviction a sector which has actually made massive wealth over last 3 years, which is specialty chemicals? 1 minute on that, please.
See, chemicals and specialty chemicals, we have been very bullish, and we have some allocation there also in our portfolio. But having said that, I would say it's not the entire basket of specialty chemicals which one can go out and buy. The reason being that the two legs of any company doing well, one leg is the P multiple expansion and second is the earnings growth. The big part of the P multiple expansion had already happened in the last 24 to 36 months, wherein you saw companies which are quoting at 10, 11 P going to 30, 35, 40 P multiple. Now from where I would say 6 months back, 8 months back, you are seeing that P multiple contraction happening. And that's the reason you would have seen many of the chemical companies, underperforming the broader market. Now, the reason is that not that they are not growing, they are definitely going to grow. They're also doing Capex. They're going to see, incremental opportunity. But I would say that big P multiple expansion is not going to happen. So now you will see those growth linked with the earnings growth of those companies. So yes, chemicals is there among the different preferences, but not among the top 3 or the top 4.
Another sector which has actually built a lot wealth over last 3 years is a very volatile sector, though. I think most fund managers hate to invest in this sector, but the sector which actually during post-COVID market rally in 2020-21 made maximum wealth is metals. So maybe one last 2 minutes on your views over next 3 years on this sector?
See, if you ask me a view on metals for 36 months, it is very, very difficult because metals is such a sector. The whole outlook changes within 6 months, considering what happens in China. Now, China is the big elephant of metals. They are also the largest producer and the largest consumer of metals. Now, whenever they have any slowdown in their economic activity, you find the international commodity prices in metals coming off drastically. And whenever their economic activity picks up, that's the time you see the metal prices going up. The other thing which leads to the metal prices going up and down is China going after their own metal companies to meet the environmental norms? Now, we have seen that in the past, whenever they shut down some plants because they were not meeting the international norms, they were not meeting the environmental norms, that's the time we saw the metal prices going up because capacities in the market, they went off the market. So I would say metals is definitely a very, very volatile sector, as you rightly mentioned. The peak of the metal cycle is behind us with regard to the prices. But I would say demand is going to be better off compared to what it was, say, 4 years back. But we will not see the peak metal demand, which we saw maybe in the last 24 to 36 months. But yes, that is so we have to put it in other way. We have already come off the peak cycle of the metal. So I would not say that this is a time to bet on metals for the medium to long run. You can get those bounces for sure because everything has fallen a lot, whether it's a Tata Steel or a Hindalco or a SAIL, everything has fallen a lot. They have also bounced back from the lows. But yes, this is not time to be having metals as a part of your core allocation. It can be more of a tactical bet wherein you just enter, you make your short-term money and you exit out of it.
So 3 sectors that you have talked about are manufacturing, financials, and energy. I echo your, I would say, views with regards to manufacturing because there is value as well as potential growth. Similarly, I echo your views with regards to financials, but I have my doubts with regards to energy. So maybe last 2-3 minutes, can you convince? Because I am trying to put myself in investor's shoe and we interact with investors every day. I can tell you this is the foremost question which even audience today would have on their mind, that though I agree that financials and manufacturing look attractive both on valuations as well as on growth, but energy may be looking attractive on valuations but doesn't seem to be kind of looking attractive on growth. It is lack of knowledge at our end, maybe versus the data and understanding or maybe deep diving or research that you guys have done while you have identified energy. So this is the last question where I wanted to focus particularly on the energy sector in terms of the underlying businesses, and where do you see growth also coming? Though we understand there is value attractiveness, but where growth is also possible, that is what we want to understand.
See, if you look at the basic numbers of the number of units of power which is consumed in the country, what gave us the conviction is that for the period ended 31st March 2022, India consumed the highest number of electricity units. We consumed roughly around 204 gigawatts of power. That number is expected to go to 220 gigawatts for FY23, which means you're seeing roughly around 8 to 10% kind of a growth in the energy unit consumption, which will happen in this year. Now, where will this new incremental 17 to 18 gigawatts of power come from? It is from the thermal power plants. It is going to come from the new solar plants which are being put. And also, what important thing is that the thermal PLFs, the plant load factors, they have started improving a lot. And that is very important to meet the energy requirement. If the thermal PLFs don't improve, then we will also fall in line with what is happening in the rest of the world. Now, what we are seeing in Europe is that, factories are being put off because the energy prices have gone over the roof. So if we have to remain competitive for power, for manufacturing, energy is the basic requirement. So if we are bullish on, if you, me, or anybody else is bullish on manufacturing, you have to be bullish on energy, because without that, factories won't run. So it is an outcome of you being bullish on manufacturing, because energy is required to run the plant.
And thank you so much for your time.
In fact, I have a very big concern that how will the world energy landscape look, say 5 years, 10 years from now, if say 25 to 30% of the IC engine automobiles, they migrate to EV. If today Europe is on the knees because of energy prices going over the roof and being a huge shortage of energy, imagine a state that almost 50% of the cars on the road were actually EVs and you have no power to charge them. It's a big unthinkable kind of a environment. So that is where I'm bullish that India has understood much earlier than the rest of the world that you need to be energy dependent on yourself and you can't depend on imported gas. That is the big issue which happened in Europe. They were all dependent on the Russian imported gas, and now with that going off, they have been hit hard. That is where I would say India is in a much better footing.
Right, and I think this is quite logical and quite convincing. I wish we could talk about respective stocks within manufacturing and within energy and within uh, manufacturing, energy, and the third sector that you talked
Financial.
about, financials, right? All of us would know, particularly stocks within financials, but in manufacturing and energy, it is good to know about the stocks, but unfortunately, we cannot talk about them. And I think the remaining questions pertain to stocks. So I beg pardon from the audience that we cannot discuss about stocks and businesses. Thank you so much, everyone, for joining us today, and thank you so much, Aniruddha, for sharing your knowledge. We'll be
A
back
pleasure
again.
as always.
Pleasure is mine.
Okay. Yeah, bye everyone.